Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Well, so here's one of the takeaways. At this point, we've discussed two alternatives. One was a very common setup that a Forex trader would normally evaluate, where they set a conditional order to get them into the market if they hit a benchmark price. So in this case, I would say that, if the market starts to move, I want to get long, and at the same time that my long order is entered, I'm going to have another order triggered that's a stop loss to protect my capital, and maybe I set it 50 pips away or 100 pips away. I mean, I'm just using this as a case study right now. But in either case, Forex traders over and over again wind up in this situation right here, where the market moves down and then eventually it does move in their direction. The advantage with the call contract is that the call, if the market moves against you, is also losing value. But you can't lose more than what you had invested. So oftentimes you hear economists talk about how intrinsic calls and puts and things like this, where you already know what your maximum risk is, and you can speculate as to what your maximum gain is, because and it makes your life a little bit easier as a trader when you're facing down extreme market volatility, which is what news trading is all about. So the advantage here with buying the call is that if the market breaks down, so if it goes against my initial forecast, which would have been, so I'm buying a September call, then I'm probably going to lose the entire investment. But I know in advance how much that investment is. It's $50 to $65 per contract. So it's roughly equivalent to, within reason, to what I was willing to risk with this outright position in the Forex itself. But the advantage here is that I already know that this is the most I can lose, but my upside is theoretically unlimited. From here till Friday, if the market goes up a lot, I'm in a pretty good situation. So by the time the market starts to cool off this morning, you can see how things were cooling off. The news had mostly been digested, and retail sales had been talked about, and we're and I keep talking about retail sales, but certainly the other news of the day from the government was not insignificant as well. So there was some surprising news as well as some news we knew about, and that started to get digested. And by the time we're up here, we're probably thinking about an exit. So this is a short-term trade, very biased very aggressively. But we can sit back and say, all right, well, how much would that call then be worth by the time we get up here? So let's do a little if then. Now, this is, obviously this is a best case scenario, but I want to be able to make the point that, we do get those best case scenarios. That's what we're trading for. So what we want to avoid is the accidents like this that eliminate the best case scenario from even materializing. And this is where, when we're facing down big volatility, that's where the cost of a call is definitely justified, I would say. So in this case, the call option, I priced it just earlier, and at the close of the market, it was about 65 cents or so, and by the time the market was cooling off, it was about $1.86. So pretty good gains. And the whole idea is, of course, so we can decide, all right, well, how much was this? What was the rate of return? And it was something better than 200%. So it definitely was an opportunity that seemed worth the risk, based on my analysis at the time. And it gave me the opportunity that I didn't have to worry so much about an accidental stop out, because sometimes, although this volatility that occurred overnight last night was relatively mild for a pre-announcement style volatility, it sometimes can be quite extreme. And in fact, I have another example as we look at, okay, so what about different time frames? What if expiration isn't in 3 days? And what if the announcement that we're trading, or the news, quote unquote, that we're trading, isn't necessarily defined in advance like this one was? So, although yesterday I might have been evaluating a trade based on the retail sales data that I knew was going to come out already, maybe I don't know, but I suspect that there's some news beginning to bubble up. Last month was a classic example. So let's bring up the dollar yen. By the way, if you're looking for the index for the dollar yen that you can chart, the FX options would be based on, the symbol is YUK. Now, I'm giving you the symbols for the indexes that are priced or that look like the currency pairs in the Forex. So euro dollar would be EUU. You can invert those. There's an index for that as well. And YUK is it matches up with the dollar yen, which is the same way that a spot Forex trader would see it as well, which is a little different than like futures traders might look at it. Now, the dollar yen is an interesting instrument. So in fact, I'm going to zoom out here just a little bit. For those of you who don't know, the yen lately, and this isn't necessarily unusual, but lately it's been acting as a safe haven investment. In fact, in many ways, there's been three currencies lately who have been acting in kind of this shelter against uncertainty role. The dollar, the U.S. dollar, has been one. It's been very sensitive to changes in the risk environment, so things like the banking crisis in Europe the last few months. The Swiss franc, it traditionally acts as a shelter against uncertainty, and it's been very problematic for the Swiss central bank to deal with right now because there's such demand for the Swiss franc, and the Japanese yen, which is also very problematic for the Bank of Japan. So when they have the ability to do something, so sometimes you will see the Bank of Japan intervene in the market and try to push prices around a little bit, and they don't like to see the yen strengthen as much as it has been. And this downtrend that you see here that's been in play since May, that's a lot of that is being driven by safety, a flight to quality, if you will, or a flight to shelter, because traders are really nervous about some of these outstanding risk factors that are still alive and well in the market. Just depending on the day, we see a bullish or bearish bias, but pretty extreme views, just depending on the day. What this says to me is that there's just a lot of uncertainty. Well, that uncertainty drives demand for safe haven investments, and that's why I think we're seeing the yen strengthen so much. Now, so we're gonna zoom in here just a little bit. Back in the middle of August, the market was, the yen itself was channeling in a pretty tight range. So I'm just going to outline this bit. And, we were waiting to see, well, what's the breakout? And in fact, from an earlier breakout, this one here in July, most traders had identified that and seen it and had been monitoring it. And just based on the size of that retracement that occurred in July and the subsequent breakout, this consolidation here in August was happening at exactly where traders would have forecasted that it would. So from a technical perspective, it was one of these situations where the market just really behaved exactly the way you thought it was going to. So everybody was waiting right here at about 85. Let me draw a quick line there. So right about 85, we were all thinking, okay, it keeps bouncing off this level. You can see this here in the shadows of the candles. Over and over again, we were expecting that there was a high likelihood for a breakout to the downside. The only thing it needed was some catalyst, some announcement. The bias was already to the downside. The trend was already in favor of that. And so if we had a gun to our head and we had to decide, all right, well, I think I'm pretty bearish. So but I don't want to get in until the market actually breaks out. The reason why I brought this one up, because it's a good example of how extreme the ultimate breakout actually was and what happened to a lot of traders. So ultimately, around about the 24th of August, there were a number of economic reports that came out, and but more than that, so I've brought up I've brought up another chart here, and in this case, we're looking at an hourly chart. And you can see that this little box that I have drawn here is let me redraw it just so you see what I'm talking about. So this box right here, that was the 24th.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.